Hey guys, in this video we're going to talk about portfolio diversification, which from an investment perspective basically means don't put all your eggs in one basket. When you've got your hard-earned savings and you want to invest, you can't put everything into one business. Because if, in this example, you put all your money into Amazon and then there was some random issue that hit Amazon, it went bust, you've lost everything, right? So at Tradewinds, one of the key things that we're trying to promote is to actually break down your investments into different categories. And we've got 4 categories. So the first one is around investing in growth stocks. So these tend to be in technology and software and e-commerce businesses, things like Microsoft, Amazon, Google, Apple, got Facebook, Adobe, and Alibaba here. These are all businesses that have a good kind of trading history and something that we're going to see, well, what will be likely secular growth, because in the future, you're making a bet that there's going to be more technology in the future than there is today. So these businesses have seen a lot of growth recently, and we expect that trend to continue. They tend to grow whether the market's going up or down. They're like secular growth and the first bucket that we invest in. The second type of company that we invest in is a cyclical company or a cyclical stock, which tends to go up and down in line with the economy. So when the times are good, economy's booming, people want to go out, they're going to buy more things. So the finance companies, banks, MasterCard, JP Morgan, Bank of America, Goldman Sachs, these guys tend to do really well when the economy is booming. People feel a bit more confident with their money. Consumer discretionary companies, I might want to buy some Nike trainers or other products that I don't really need, but I just want them. So they tend to do well when the markets are going up. And equally, if there is a recession, as we're potentially experiencing right now, as at the time of making this video, people don't spend as much. These types of businesses don't perform as well in the down times. Something like a Disney subscription, I might switch off because I'm looking to tighten up the purse strings. So these businesses tend to go up and down. And then the third kind of key group here is defensive businesses, right? So whether the market's going up or down, I'm going to invest in things because I just need them, right? Consumer discretionary, I'm going to buy things at my discretion because I kind of want them. Consumer staples, what we're seeing here in the defensive row, are things I actually need, right? Not things I want, things I need. So Johnson & Johnson, might need to buy some talcum powder for my baby. Healthcare tends to be in this defensive play because people's health, needs to be looked after whether the market's going up or down. If I'm having a heart attack, I don't really care that there's a recession on, I'm going to want some healthcare, right? So these things generally tend to just tick along all the time, right? Irrespective of the market. Got here PepsiCo, McDonald's, they tend to be quite consistent, right? And so we have them as a defensive play. And then the final piece is something called an ETF. If you're not familiar with that, that stands for Exchange Traded Fund. And it's basically a collection or a basket of many different stocks, all in one instrument that you can trade. So if you want to just buy the S&P 500, you can buy a share, of the SPY or QQQ, that's the NASDAQ 100. These ETFs vary by country. So you've got separate ETF tickers here for China or Australia, and also by sector. And we'll go more into that later in the video. So portfolio diversification means that you buy different stocks within those categories. So let's say I want to buy 10 stocks, right? I'm not going to buy all technology. I'm not going to buy all healthcare. I'm going to mix it up and I'm going to have that diversification in my portfolio. So I've got Amazon, Microsoft, and Adobe in blue, 1, 2, 3. I've got 3 stocks here for growth. You can see in green here cyclical, so MasterCard, Nike, and 3M. I've got 3 cyclical plays there. I've got 2 defensive stocks here, Johnson & Johnson and Procter & Gamble. And then I might go for 2 ETFs, right? So 10 stocks, diversified portfolio. If I had $1,000 to invest, I might put $100 against each one. And so I've got 10% allocated to each type of stock. Now, when we invest, we don't invest the $1,000 all in one stock and all at one time. We obviously have said if we had $1,000, we've got 10 stocks, that's going to give us $100, right, to invest in Microsoft. So as value investors, we want to know what is the true value of that business. Let's say, for argument's sake, it's $340. We think Microsoft is worth $340. So we're going to buy maybe when the price retraces back to a level of support. The TradeWinds, we use moving average levels of support. If you want to learn more about that, please click the link below. We might invest then in a next tranche at a lower level of support. So you can see that generally when price pulls back, nothing goes up in a straight line forever. When price pulls back, it finds support at these moving average lines. You know, it kind of finds support at the purple line. As long as it's below the intrinsic value, you're going to be picking the stock up at a discount, right? So we had $1,000 for the portfolio. 10 stocks is $100 a stock. 100 divided by 4, you've got $25 ready on the sidelines waiting for price to interact with these levels of support. So that's how we scale in per stock. Now, ETFs are great because they allow you to get exposure to different sectors. And I recommend you check out this website here, which are the SPDR ETFs. And so you've got here different tickers here, XLE, XLU. Those tickers all give you exposure to different sectors, right? So you've got XLC, and that gives you exposure to companies in the communication services sector. Or if you're interested in tech, you know, you look at XLK, that's the technology, you can buy that ETF. And this website, you know, if you click on it, it updates and it shows you over any time period. I've put here the longest one, 5-year time period. The S&P 500, that's just the general market, that returned just over 81%. And then you can look at how all the sectors have performed over that 5 years relative to the market. So if the S&P went up 81%, we want to be beating the market, right? Otherwise, we could just buy the market. We want to outperform the market. So we might try and choose stocks that are in these sectors that are outperforming the market. So what is bigger than 81%? Well, consumer discretionary over the last 5 years has gone up 99%. Healthcare is there or thereabouts. And technology, obviously, is the biggest outperformer there, 169%. So, you know, you want to just get a feel for what is performing. Something like communication services hasn't really performed that well at all, right? So energy, very volatile, not something we normally touch. This can give you some insight on what to invest in. Now, we focus on ETFs that are made up of companies, and we're buying shares in different businesses. Just for info, just sharing that you can also buy ETFs that are nothing to do with stocks. So there's ETFs that give you exposure to different types of bond market, or if you're interested in commodities, you can buy ETFs that focus on the price of gold or silver or oil or any other type of commodity, you know, real estate, crypto, etc. So we won't dwell on this, but if you're interested in those types of ETFs, just for your own research, you can go to 2 websites that I'd recommend, ETF.com or the ETF database. You can click on either of those. They've got really good search functionality in there. If you want to find an ETF for gold, for this country or for the world, you know, you can key it into there and off you go. So ETFs, you want to, obviously, when you select an ETF, you want to look at what markets are performing the best. And then you want to make sure that you're only buying an ETF through a reputable provider. So as you can see here, these are some of the big names. You've probably heard of BlackRock, Vanguard, State Street, etc. When you're looking at an ETF, you know, like everything else in life, you've got to shop around, right? So these are effectively funds. This is an exchange traded fund. So there is a fund manager in there who's making sure you've got the right companies that are in that fund. And, you know, much like managing a football team, you might chop and change people or companies in and out of that fund. And so they will charge a management fee. You want to compare, you know, the ETF fees across different providers to make sure you're getting value, and obviously check that the ETF is performing, right? So look over the last year, the last 5 years, if it even has 5 years of performance track record, right? And just make sure you're getting a high performing ETF, or whatever it is you're interested in. Don't stray too far from the main fund managers here. You do get new fund providers coming up. You want to make sure you stick with those that have the best track record, and obviously get into the fund. What is the size of it? What companies are in there? What's the allocation, etc. And do they actually hold real shares? You don't want to, you know, get into any synthetic ETFs, as they're known as. You want to make sure you're buying ETFs with real companies in. And the ones that we really focus on here at TradeWinds, we're looking to get that broad index exposure. If you want to, you know, look at the S&P 500, the ticker is SPY. And that's probably one of the more famous ETFs that you can invest in. That's from State Street. You've got the NASDAQ 100, the QQQ, run by Invesco. Dow Jones is DIA. Maybe you actually want to get a bit of exposure in China. You know, you can look at mainland China, Shanghai, GXC, ASHR. You can put that into Google. The key thing there is to get the fact sheet, like look at the performance, look at what comprises the ETF. In Australia, if you just want to get a broad market indices, Beta Shares has the A200. So we'll probably hit pause there. If you've got any questions, please don't hesitate to reach out to us, and make sure that when you're building your portfolio with TradeWinds, that you're scaling in across a diversified selection of stocks. And if you're going into the ETF space, you're doing so through the big name providers. Many thanks.